And so the biggest pitfall that most realtors are also scared to death of is that you get a pre-approval that's not good.
Welcome to the Veterinary Financial Podcast, where we discuss financial freedom and whole life success. I'm Meredith Jones, a veterinarian and financial planner.
And I'm Willie Bedott, a lab animal specialist and a money nerd.
Our guest today is David Aizuss. He's a financial planner at SLP Wealth, a student loan consultant at Student Loan Planner, and a mortgage loan officer. David, welcome to the show.
Thanks for having me. I'm honored to be on here. I've listened to a bunch of your guys' episodes. Funny enough, I originally had my and my wife's original student loan consult because she found your guys' podcast back in 2021. So it's kind of surreal being on here. So thanks for having me.
That's awesome. That's a great story.
Yeah, that's amazing. All right. So, David, you have years of experience working as a mortgage loan officer, helping people buy and sell homes. And now you've joined the veterinarian team with me at SLP Wealth, helping veterinarians with financial planning. And so why the switch to financial planning, and why did you decide to work with veterinarians?
I'll answer the second part of that question first. Why do I want to work with veterinarians? And one, I don't know if you can see me if this is being posted anywhere besides Spotify, but if you see my cat walk across the screen, I'm sorry about that, but vets, so you guys should be understanding, right? So why do I want to work with vets? Well, it all started with a girl back when I was 15, and now I'm married to that girl who became a veterinarian. So, my life has always been with someone on the veterinarian track because, becoming a vet, it is life consuming, right? You've probably wanted to do it for as long as you could remember. It's your life going into college, after college, vet school. It's, again, all consuming. And then once you're actually a vet, it is still kind of all consuming, right? It's not your typical profession. I think it's the most underappreciated profession. Just from all the crazy stories I hear every single day from my wife. She's a GP out here in San Diego. You guys do a lot of great work. You help tons of people. You obviously help and save tons of animals' lives. It's, I think, one of the toughest professions out there. That's one of the most underserved as far as financial planning goes. And it's what I know the most as far as any profession outside of my own. So it's just kind of, if I'm going to do financial planning, it makes sense that I'd focus on vets because that's what I eat, breathe, and live kind of every single day, right? I hope that answers the second part of your question. The first one, this is juicy. Why make the switch, right? A little bit about me. So my professional life has kind of just been grabbing the next best opportunity that comes my way. I've always wanted to be a financial planner, probably since the end of high school. But it's not like you can just snap your fingers and become a financial planner, right? Yes, you can get the designations on your own, but, that's different than getting a job, right? And a lot of the jobs you could kind of get if you just, don't know anything about the financial planning world and you try to be a financial planner, 9 times out of 10, you might find yourself at, a place where you end up selling insurance. And they call it financial advising. Nothing against insurance salesmen. We need insurance. That's a whole other topic, right? But it's not fiduciary, fee-based, fee-only financial planning that you can just snap your fingers and get a job doing that, right? And so out of college, I helped run a music school. I'm also a musician. And the owner, which is like a second family to me at this point, and this is up in Oregon, he's a family business advisor. So the music was kind of just a passion project, and I said, well, if I'm going to do this after college, I need to pursue something else besides music because I do like making money. And he's like, well, what do you want to do? Well, I mentioned a few different things, and it just so happened that one of the things I mentioned besides financial planning was being a commercial real estate appraiser because I knew someone who had done that prior, who was a grade ahead of me. And he was like, oh, one of my clients or past clients is the major appraisal firm in town. There's only so many of them for commercial real estate appraising. So one thing led to another. I did that because that was the opportunity that presented itself through the connections that I, just knew. So I cut my teeth doing that for about 3 years, learned a ton. Wasn't client facing though, think 200 plus page investment reports, right, for banks. I did specialize in medical offices, retail, that kind of stuff, right? And COVID hit, it got twice as hard, the turn times got twice as fast, and for less pay. And throughout college and before college, I had a background in sales, and I really liked helping people, right? And so I loved all the finance components of appraising, but I missed the client-facing aspect of like consulting and helping people solve their problems, right? And so it just kind of all led to mortgage because my buddy that I've known since I was like 5, he was the best man at my wedding, he didn't go into appraising after college. He went into mortgage as a loan officer, did very well. He started in like 2019. He became a manager at that brokerage he was working at. And for years, he was trying to convert me to come back to San Diego, because I'm at Oregon at this point, to be a loan officer. He's like, you got the finance background, you got the sales background, you'd make twice as much doing half the work as what you're doing. Because I was pulling all-nighters at that point, doing the appraising. It was just not sustainable, for me at least. And so I just had to look myself in the mirror and say, I think I'm a good appraiser. I don't think it's my life calling, though. I'm not good enough. And I think I'd be better at this mortgage thing. I wish I switched earlier, because I switched January of 2021. It was when I got my license and started working. But so I missed 2020 and the easy money that was to be had there. But what can you do? And I loved it. I'm still technically a mortgage loan officer. I'm still licensed California, Oregon, Florida, Arizona, and Ohio. Mostly still do business in California and Arizona. So I'm not done with it, but I don't spend nearly the same amount of time as it. I'm really 99% of my time is now in financial planning. And the reason, again, for the switch is the opportunity presented itself. I saw that SLP was hiring. I had known them prior because I'd gotten a consult done for my wife and I loved all the work that they did. And so I just reached out when I saw that they were hiring and kind of bombarded all the partners on LinkedIn, and one thing led to another, and now I'm doing this full time. And as a mortgage loan officer, you know, it is the closest thing to being a financial planner without being a financial planner if you're a good one, because you need to know how to analyze income. You need to know how to analyze someone's assets. You need to know how to analyze someone's financial needs, wants, and goals, and how to structure their loan to meet all those financial needs, wants, and goals. And if you're a good LO, then, you know, you're probably a decent financial planner. But not every LO cares about doing that, right? They just care about the next buck. Not everyone. There's plenty of good ones, right? It's just because I'd always wanted to be a financial planner, I treated my mortgage business as pretending I was. And I would always say, you know, if I wasn't a loan officer, I'd probably be a financial planner, is what I'd always tell my clients. And so when the opportunity presented itself, you know, I made the switch and I really love it. And now I get to work with vets primarily too on the financial planning side. I love student loan consulting too. That's a lot of fun. So again, why the switch? And sorry for the long answer, is just because the opportunity presented itself at the right time. And at the end of the day, it is what I kind of always wanted to do. I just never got the opportunity before.
And, you know, again, that's why we have you here, because housing is one of the biggest expenses for individuals. So I want to figure out some stuff with the housing market currently. You know, I've been renting pretty much my whole life. I owned a house from 2019 to 2020. Then I sold it pretty quick. But now me and my wife are actually interested in buying a home soon. So what are the most important things to keep in mind to set ourselves for success for that purchase?
Well, without just doing a full-on pre-approval, which maybe that's a whole nother podcast episode, that'd be kind of cool. See a real pre-approval in action. Some things to just consider is, do you have any debt that's not your student loans? We can talk about student loans later, but like auto loans, personal loans, credit cards, with regards to the housing market, the more you can get rid of that kind of stuff, what I'd call bad debt, consumer debt, one, the more affordable your mortgage payment's going to be, right? If you don't have $1,200 in auto loans that you have to worry about, well, that's $1,200 that could be going into your mortgage, or just $1,200 less total, right? And so the way to think about it too, and most people don't think about it this way, you know, $500 a month in an auto loan, depending on what interest rates are doing, that's anywhere between 80 to sometimes even $150,000 difference in the mortgage amount that you could qualify for. 2 fancy cars, you have $1,200 of car loans. That'd be $300,000 of loan that you could qualify for. Ooh, depending on the area you're in, that's the difference between buying and not buying, right? Because can you buy a $200,000 home? Probably not. Can you buy a $500,000 home? In a lot of areas, yeah, you could buy a real nice one. So I would say clean up your bad debt as much as possible if you have any. Focus on income. And this is vet specific too. Depending on the type of vet you are, right? Income matters. If you're an associate employee, like a W-2 employee, not a, let's say, 1099 relief vet, or let's say you're not a practice owner, right? If you're an employee vet and you're always hitting your production, like if you're on ProSal, maybe you try see if your employer is open to raising your base. Because if you're always hitting production and you raise your base lower than what your, total pay would be with production, then they really shouldn't matter that much to the employer. It's the same cost to them. But meanwhile, it's way easier to qualify for a loan. Because and I won't get too into details unless you want me to, but qualifying your production component of your pay, anything that's variable, is 10 times harder than that base component. You can do it, but you need a good LO who's willing to walk you through it and maybe even go so far as calling that third to last employer's HR person that you didn't like so much to teach them how to fill out a random mortgage doc so that way we can qualify that bonus income from 2 years ago, right? It gets hard, especially once trying to do that within 2 weeks because now you're under contract and meeting deadlines, right? So I don't know if that answered your question. It's just focus on getting rid of your bad debt, focus on increasing income, and if possible, increase your base as a vet.
Yeah, that's a good one because I think a lot of vets don't really think about that because it's like the take home ends up being the same amount of money. And I've met some vets who even kind of prefer it that way because they like getting those big, production checks. But yeah, I think taking a look at your base, that's really good advice. And so a mortgage loan officer, so if someone is looking to buy a home soon, how do they find a good one?
I wish I had a magic answer to that one. You're going to need to do some work. Just period, end of story. And hopefully not too much. If you know any fellow veterinarians who purchased homes within the last 2 years, ask them what their experience was like. And assuming they didn't pay cash, they probably used the loan officer. Whenever you hear LO, it stands for loan officer. It's the person doing the mortgage who's going to walk you through the whole home buying process that has nothing to do with going and walking to see the home, but everything after, right? And how to find a good one, again, if you're vet friends, because vets tend to know a lot of other vets, right? And a lot of other vets may or may not have purchased a home in the last 2 or 3 years. If they had a great experience with their LO, I'd give them a call. Right? So referrals are, I think, number one, friends and family, because it doesn't have to necessarily be someone that, was a vet, right? If you have trusted friends and family who purchased within the last 2 to 3 years and they had a great experience with their LO, I'd reach out to them. And I'd probably interview at least 2, probably 3. You probably don't need to interview more than 3. And just whoever you trust the most, because, you'll have to go with your gut, but if after talking with them for 15 minutes, you feel like you'd want to have a beer with them, that you feel like that they'd pick up the phone on a Saturday when you're out making offers, right? At pretty much any time, cool. If you feel like they know a thing or two about personal finance and can structure the loan to meet your financial needs, wants, and goals, it's all about that trust. And so interview 2 or 3 friends and family referrals. I think that's the best way to go. And if you can't, then you'll have to use, online reviews. But again, that's not terrible. It's just interview 2 or 3 and see if you trust them.
Okay, so I imagine this person is the one that's going to help you with whatever the pre-approval means. So what's a pre-approval and what are some potential pitfalls to watch out for?
Great question. So pre-approvals. When you go to make an offer on a property, right, and you're using financing, well, the seller's realtor and the seller need to know that you're not full of BS, right? Because they need something to say that, hey, I'm good for this loan. I'm not going to get denied, right? And that's what a pre-approval letter is it tells the seller and the seller's realtor that you've already met with a lender and that lender says you're good to go. That's all it is. Now, secret of the industry, all a pre-approval really is someone's opinion. And opinions can be right or wrong, right? And so you got to be really careful. How was that pre-approval made? Was that pre-approval made because you went to some online lender, never talked to a person, and you put in what you think the underwriters will use for your income? Because, by the way, vets or not, 99% of people don't know how much money they make. Like, they actually don't know. Let alone, are you self-employed? Are you not self-employed? Pro-sal? Do underwriters know how that works? Are you calculating your bonus income right? Because if you ask my wife, she makes about 20 to 30 grand less per year than she actually makes.
Yep.
So, because a lot of vets are very conservative, right? Which is great for us as financial planners, but like, if you're going to an online pre-approval and you're too conservative on your income, you might get a denial, but it's not a real denial. You just put your income in wrong, right? Or what's even worse, vice versa, is maybe you don't know the underwriting guidelines for conventional loans, for vet physician loans, for FHA loans, because they're all different, right? And maybe they would calculate your self-employment income or your pro-sal bonus portion differently than you would. 9 times out of 10 they would. Or maybe they would calculate your debts different too, right? Student loans or not. And so if you just go to some online lender, plug in all the variables that the loan application asks for, yes, they can take that loan application and run it through an automated underwriting system to kick out an approval or denial. But that approval or denial is only as good as the inputs that are made, right? And if the inputs are made by you and not a professional who understands underwriting guidelines better than the underwriters do, and the underwriter, by the way, is the person who's going to be looking at your loan after you're already under contract, right? So technically, a pre-approval, your loan ain't done. Your loan hasn't even started. Your loan doesn't really exist until you have a property under contract, which could take 4 months if you're looking actively, right? And so the biggest pitfall that most realtors are also scared to death of is that you get a pre-approval that's not good, that the lender didn't do their due diligence, they didn't poke as many holes in the loan as possible, they didn't calculate your income or debts correctly, and now you use that pre-approval, you break your lease, or you end your lease, now you're under contract, you got the moving truck all ready to go, and then 2 weeks into your loan, you get an uh-oh call from your loan officer saying, hey, we're having a problem, we can't close. Now you're homeless, or you got to go find a new place to live. That sucks, and it happens. Or, hey, we can close, but there's this $15,000 debt that we need to pay off that I didn't think you had to, but now we have to. Can you just go pay that off right now? What? You think I just have 15 grand? Imagine that extra cost halfway through the process where you're already stressed out of your mind, moving, closing, all that stuff, right? So the biggest pitfall is just trusting a pre-approval, like know who's doing it. And if you trust the person doing it and they say, it's ironclad, I take this seriously, I've never not closed a purchase loan before that I issued the pre-approval from start, then you're probably good. If you get it from someone that you've never heard of before just because they promised you a low rate, which, by the way, rates don't exist until you're under contract anyway, and they change every day. So, never get a pre-approval just because somebody promised you a low rate, because it doesn't exist. That's the biggest pitfall.
Mm-hmm.
Is there an inquiry to your credit?
If you're doing a correct pre-approval, yes. There are some lenders, and it's not bad, it's just strategy, right? You could issue a pre-approval and I do a soft pull, or I don't pull all 3 of your credit scores, right? You can do that. Here's the risk of doing that, though. If you do that and you didn't look at the full credit report and now you go under contract and you're like, okay, well, now I got to do the real credit pull. And then what if you pull it 4 months after the pre-approval and now there's something on there that is an uh-oh that you could have seen during the pre-approval and then encountered the issue then and solved for the issue? Well, now you're trying to solve for the issue with 15 days while you're already under contract. And if you fail, the loan's dead. Right? So you're going to have to get a full credit pull at some point, no matter what you do. So you might as well do it before you're under contract, not while you're under contract, right? Your score is going to be the same. It's just, when do you want to know? Now or later? That's it. I want to know now. So that way we can solve any O's beforehand. Maybe we can even get it up to if I can see, credit utilization on this card, like, oh, you pay this one card off by $500, now your score is up by 30 points. There's a lot of cool tricks that a lender can do. Like, there's a lot of harm that can happen if you don't want them to pull your credit, and a whole lot of good they can do if they're a trusted advisor by pulling your credit. No one likes pulling your credit. Like, I don't want to pull your credit. So, like, don't be taken back when a lender says, yeah, I need to pull your credit. It's like, they have to. That's it.
Okay.
All right. Cool. So, David, going back to what you said about vets and estimating their income, of course, we talk to a lot of veterinarians about their student loans, right? And so that comes into play with that as well, where it's like, okay, if you underestimate your income that you're giving me during a student loan consult, and then you recertify your income, have you gotten those emails where people are like, my payment is higher than what you projected? And then it's like, oh, let's pull your tax return, So David, a lot of vets worry about student debt impacting their ability to buy a home. Could you talk a little bit about that and whether that should be a concern for them?
Yeah, of course. Well, unfortunately, yes, it can impact your ability to buy a home, but I wouldn't lose any sleep over it. And here's why. Yes, you have debt, and the lender could use a million different things for that proposed debt payment because of how wonky student loans are. And yes, it could impact your qualification. But find a loan officer who's up to date on all the student loan changes that have been happening recently. That might be harder to do, but hey, maybe not if you know a vet who liked their loan officer, because most vets have a lot of student loans, right? Well, first, if you have no other debt and you're buying within your means, maybe no matter how they calculate your student loan payment, because what they're really going to do is look on your credit report, and what's on your credit report isn't always the same payment as your income-driven repayment is. Like, it might even default to the standard 10-year, which could be double, triple what your actual payment is. And that lender, if they don't do anything from that point forth, that might be enough to kill your debt-to-income ratio. Or maybe you make enough money and have no other debt, like why it's good to not have car loans, personal loans, credit card debt. Maybe you make enough where it doesn't matter. Like, maybe using the pretend 10-year, especially if you have a co-borrower, maybe it's a non-issue. Cool. That's the best case scenario. Great. Didn't matter. But if it does matter, that's when it's like, have that conversation with your loan officer. Let them know, are you in an income-driven repayment plan? Are you not? What is your actual real payment? Because it's probably different than what they're seeing on the credit report. And let them know how long is that payment going to be for, right? So know what your IDR recertification date or anniversary date is going to be. And just consult with your loan officer ahead of time, like when you first meet them, so that way they can do the research that they need to do to make sure that they're choosing the right loan product. Because Fannie Mae versus Freddie Mac, both conventional loans, they treat them slightly differently, student loans. FHA has their own quirks. VA has their own quirks. And physician loans have their own quirks. And so just know what your IDR payment is if that's what you're on, and know how long you're going to be in it for until it's set to switch again. With the IDR dates changing recently, lenders are honestly probably very confused. Mm-hmm. If debt to income is tight, like, it kind of sucks, but expect some back and forth with an LO who's going to need to do some research.
Yeah, for sure.
Because things are changing every few months at this rate. Like March, they kicked the recertification date out a year. What does that mean for lenders? Every lender might be a little bit different. Mm-hmm. Does that answer the question?
Yes.
Yeah, that definitely answers the question. And, the whole complicated, I've been consulting with Meredith recently because, I used to be on point with my student loans, and now I'm a little bit lost with everything that's happening. And Mohila being removed as a lender, or at least for my loans. And it's just like, okay, should I be doing anything? Should I be paying? Should I just stop paying and see when the treasury, whatever.
Yep.
So I imagine that's complicated for the person that has the loan, and I can't imagine for somebody else that's just looking at it from afar.
It sucks. There's sometimes you need to do what's called a letter of explanation during the loan process, where like the lender's like, what is this? What does this mean? Why did you do that? Like, explain. And if you don't explain it in the correct way in like underwriter talk, like you need to construct that letter kind of like a lawyer would, right? this is where the good LO comes in. Like if, your loans were impacted because you were with Mohila, but now they're transitioning you to another servicer, or you were expecting to be with Nelnet because you wanted to consolidate, but now they're not taking consolidations and they're moving you around, right? If servicer changes are happening and it's populating your credit report and they can see that, like most of these underwriters, most LOs, like until I was a student loan consultant, if you told me that, oh, my servicing changed because of Mohila and all this stuff with the incomes recertification date being kicked out again a year from March, but it was originally, to no sooner than November, but like they actually kicked it out a year. They didn't just move it. Like if you talk about that with someone who's never encountered like the nuances of student loans before, it's just like that all went over your head. Right. And so most of this is going over lenders' heads. And so the more you can know about what's your current payment, how long is your current payment set for, what is that servicer change, why did it happen? And you can articulate that to a competent loan officer, and that loan officer will know how to explain it to the underwriter. 50% of loans, even the cleanest of loans, the way I'd be able to close it faster is I'd call the underwriter on the file to explain things that aren't clear just from the loan app. And that would get rid of what's called conditions. Whenever you submit a loan to underwriting, like you get under contract, an underwriter basically has a list of things that you have to prove, clear, or answer for them. And it can be scary if you don't have someone to walk you through it, right? And so letters of explanation, common condition, it might happen more often with all the changes in student loan world. And again, it's just the more you can articulate what's happening to your loan officer, then the more that the loan officer can articulate what's happening to the underwriter. And then it should be fine. So I don't know if that answers the question. I feel like every mortgage question is, it depends. Talk with your lender. But it's true.
That's the answer to many questions. So we really appreciate, like, again, you're talking about stuff that I have, I bought a house once, but I can't remember. I called my bank. I just asked, hey, I want to buy a house. And then I guess they assigned me a loan officer and then he moved forward. And that was the only loan officer that I looked at. So for our listeners, what is the best way for them to get in touch with you?
Best way to get in touch with me, probably by email. My direct email is david@slpwealth.com. Super easy. David, David, at slpwealth.com. All spelled normally. Yeah, that is probably the absolute best way to get in touch with me.
Thank you.
All right. Awesome. So in our next episode, we're going to continue the conversation with David and take a deeper dive into mortgages and how to save money at closing. Thanks, David, for joining us today.
No problem. Thanks for having me. My pleasure.
If you liked this episode, click the follow or subscribe button. Until next time, take care and continue your path to financial success.
The information provided in this podcast is for informational purposes only. It should not be considered legal or financial advice. Consult with a legal or financial professional before making any investment decisions.